The housing market has had an absolutely crazy time over the last year. When the virus hit, the world panicked. Governments shut their countries down, real estate agents were banned from showing houses, millions lost their jobs, and the consensus amongst pretty much everyone was that a housing market crash was imminent. Prices were high, affordability was low, and suddenly a virus ripped through the world that forced millions of people to stop working, to make them stay at home, and to stop spending their money. It's no surprise that everyone in the world thought a crash was coming. It seemed like the most logical outcome, and obviously that never happened. Instead, the housing markets in the US, Canada, the UK, and Australia all exploded. We've seen ridiculous growth that didn't really make any sense, of 15%, 20%, and even 25% in some areas. Now, despite these ridiculous levels of growth that are without a doubt unsustainable, lots of people think that the market is just going to keep going up. But that's not what the banks think is going to happen. No, the largest banks in the world are busy preparing for the next crash. And the big problem with this is that the banks just preparing for a crash could actually be the cause of a crash. Now today, I'm going to show you all what the big banks are thinking, what they're doing, and why they're predicting a housing market crash. But really quickly, if you're new here, subscribe to the channel. We're putting out loads of videos just like this constantly that you don't want to miss out on. So if we want to truly understand the market today, we need to look at the market yesterday and work out why the housing market crash that the world predicted never happened. And the answer is much simpler than it might seem. In essence, the markets were propped up by the governments. When our governments decided to lock the nation down, they forced us into a very weird recession, where we all wanted to work, we all had jobs to work, we wanted to spend our money, and we had businesses willing to take our money, but the government wouldn't let us. In a normal recession, demand usually dries up. People are scared, they're losing their jobs, they're taking pay cuts so they spend less money and save more just in case it all goes south for them. This means that more businesses start to lose money as well because they're losing their customers. So they cut staff, which hurts other businesses even more. This process goes around and around time after time, creating a feedback loop where the recession or the crash is made even worse by the fact that there is a recession or a crash. But during 2020, this never happened because the recession wasn't caused by market forces. The governments caused this recession in reaction to the virus, and so the governments tried their best to help people. They started sending out money to people and to businesses. They increased unemployment benefits. They prevented evictions for those who couldn't pay rent, and they prevented foreclosures for those who couldn't pay their mortgages. This meant that those predicted evictions never happened, and those predicted foreclosures never happened either. The imminent housing market crash that the world was so sure would happen was successfully prevented. But then people got comfortable, and they realized that the lockdown wasn't as scary as initially thought. People were working from home, they were still earning money, but they weren't spending as much. They didn't have to pay for gas for their car journey to work each day. They didn't have to buy a coffee at the train station. They didn't spend as much on shopping trips or hotels overseas. The world was forced to save their money instead of spending it. So that's what they did. Suddenly, people who used to live paycheck to paycheck had money left over each week, and they saved up a little bit over time, and they decided that they wanted a bigger, nicer home. This makes perfect sense. People were spending more time at home. They weren't out at the weekends. They weren't out during the day. People wanted a bigger garden or a home office, and they had the money to upsize, so they did. This happened on an absolutely huge scale all around the world. Millions of people decided that now was the time to buy the home of their dreams. And as millions of people were buying, demand for houses soared. It was common for people to offer 10% over asking price and to still be outbid by someone else offering even more. And at the same time as more people were buying, less houses were being built. Costs of buildings shot up. Lumber increased in price by over 200%. Many people were being paid by the government to stay at home, so why on earth would they want to work on a building site? This drove down supply. Companies didn't want to build houses, and when they did want to, the government wouldn't let them. This increase in demand and decrease of supply forced prices higher and higher, and gave us the crazy levels of growth that we saw over the last year. It seems so clear to us now that this is what happened, but it wasn't clear last year, and no one, truly no one, saw it coming. So now we get into the meat of this video. The banks that are predicting a housing market crash and why. Now I'll give you guys a quick overview of this before going more in depth and explaining everything in much more detail. So in short, banks are making it harder to buy homes, and they're doing this on purpose. It is more difficult than ever to get a loan on a house because the banks don't want to loan people money to buy homes. They are afraid the housing market is overvalued, The government's halting of foreclosures and evictions means that there are a lot of people out there who have not made payments on their homes, and when they are finally evicted and their homes get put on the market, this will flood the market with supply and prices will start to collapse just like they did in 2008. The banks are afraid of a market crash, so they are tightening the market, which ironically could be what causes the next housing market crash. Bank of America, JP Morgan, and all the other major banks in America are afraid that the market is in a bubble and they are acting accordingly. Now, if you want to see the data that proves this, then you have to look no further than the Mortgage Availability Index. Now, this is basically a set of data that shows you how easy or hard it is to get a mortgage at any point in time. By looking at this data, we can see very clearly what is going on. In the early 2010s, when the world was still reeling from the housing market crash, it was very difficult to get a mortgage. The banks required you to have a good down payment, a good credit score, a good history of paying down your debt, and a good income that would easily cover the mortgage. This was because the banks were afraid of lending out too much money on homes that weren't worth what they thought they were, which is what happened in 2008. But as the economy started to move again, as people got wealthier and the housing market recovered, the banks got more comfortable lending money again. The requirements loosened and people bought more homes. You can see very clearly the index rising from 2014 and onward as it gets easier and easier to get a mortgage. But in 2020, when the world shut down, the index collapsed. Almost overnight, every bank in the world thought a housing market crash was imminent and they tightened their lending policies. They stopped giving out loans as they were afraid that the houses that they were backed against would collapse in value. This is shown very clearly by the sharp and almost instant decline in the index. But as already mentioned, that crash never came and the banks slowly got a little bit more confident as prices continued to rise. Loans got a little bit easier to find and the banks relaxed again. That was until last month. Once again, banks all over the world have become convinced that a crash is coming and they have once again tightened their lending policies. You can see how sharp this drop in the graph was, and there's no telling how long this drop will last for. There is no doubt in the world that the banks are once again forecasting a housing market crash. So why do the banks think the market is about to crash? Well, it comes down to two main points. Firstly, inflation is high, really high. It's higher than it's ever been since the last housing market crash in 2008. The government have been printing so much money over the last year and pumping it into the economy that prices in pretty much every industry have increased. And if these prices continue to increase, which it seems like they will, then interest rates will be forced to rise. If they don't rise, then we risk hyperinflation and a devastated economy like that of Weimar Germany, Zimbabwe or Venezuela. The problem is that an interest rate rise could crash the markets as well. If you are able to spend $1,000 a month on your mortgage, then with the current interest rates, you could get a loan of around $300,000. If, however, interest rates rise to the historical average of 5 or 6%, then you could only afford a mortgage of $100,000. An interest rate rise like that could cause millions of people to be unable to afford the mortgages on their current homes, and it could mean that millions of people wouldn't be able to afford to buy houses at their current prices. The only possibility, if that happens, is for housing prices to fall in a fashion very similar to the 2008 housing market crash. At some point, however, the rules will revert back to normal and the banks who basically own these houses will put them up for sale, which will flood the market with inventory. Suddenly, the market will change from having too many buyers to too many sellers, and prices will be forced down. This will all cause a price collapse, especially if it all happens at once. All in all, the banks have looked at the data and they have decided that it is a dangerous time to be handing out mortgages. They are making it more and more difficult for people to get mortgages in order to reduce their own risk to the housing market crash. Now, what the banks aren't saying is when they think the market will crash, and to be honest, even if they did, they would probably get the time frame wrong anyway. Now, all of this isn't to say that you should absolutely not buy a house. Every market is different. Everyone's circumstances are different and it's impossible to give one answer to everyone in the world. What can be said is that everyone should be careful if they are looking to buy a house. People should make sure that they can afford their mortgage if rates rise, and they should also make sure that they can stay in their home for the foreseeable future if they have to. In short, we should be responsible with our finances, not careless. If you're new to the channel and you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then like the video and leave a comment, and YouTube will do its part by pushing this video out to more people just like you. There are links down below in the description where you can get a free $25 from Crypto.com, a free $25 from BlockFi, and up to $2,300 in free stocks from Webull. It's the closest thing to free money you'll ever get, so make sure to check that out. Thanks for watching. Until next time.